Bismillahirrahmanirrahim. Assalamu alaikum viewers, you are welcome in this video. This video is a continuation of my previous video on a topic of ratio analysis, wherein I had discussed the importance of ratio analysis, its usage, and different categories of ratio analysis. In the previous video, I had discussed the first category of ratio analysis, namely liquidity ratios. I had covered all three liquidity ratios under that category. In this video, I will cover the second category of ratio analysis, namely solvency ratios. Viewers, when we talk about solvency ratios, solvency refers to the viability, the company's long-term financial viability, and also through solvency ratios we can check the company's going concern assumption. When we talk about solvency, meaning we are going to check the long-term financial viability of a company. The ratios that we can use under this category to check the financial viability of the company include debt to capital ratio, debt ratio, interest coverage ratio, and equity multiplier. Viewers, solvency ratios are mainly used by governments, banks, individuals, employees, and institutional investors. Viewers, when we talk about debt to capital ratio, it is also referred to as D/C. In short, we can write debt to capital ratio. It measures how much debt a company is having. So higher the ratio, it means that the company is having more debt, it is more levered, and the risk is more. Because highly levered firms during a time of economic downturn, they face very difficult situation to repay their debt installments. So if this ratio is less, so it means that the company is having a lesser amount of debt and the company can repay its debt installments without feeling a burden. But when we check this ratio, we need to see so many other factors. Those factors as of now I am not discussing, just to keep my discussion simple. As you can see, debt to capital ratio, the formula is total debt divided by total debt plus shareholders equity. The sum of total debt plus shareholders equity, it gives us total capital of the company, and we check total debt in relation to total debt plus total shareholders equity, meaning the total capital. And I have already discussed that if the company experiences a downturn in profit in a situation when it is having a higher ratio of debt to capital, so it impacts the ability to pay back loans, which has a higher risk for the company. There is one example through which we can understand it better. You can see here that total debt is $450,000 and total equity is $1 million. So when we add debt and equity, so this will give us total capital, and we check this total debt, we divide this total debt by this total capital, so it will give us overall percentage. So consider if a high ratio seriously impacts the organization or not. While a higher amount of debt may impact one company, another may not feel the same effect. It is best to look at several factors that contribute to the debt, such as monthly loan payments and how soon the company can pay off the debt. The next ratio is about debt to asset ratio. Debt to asset ratio, it checks the amount of total debt in comparison of the total assets. So higher the ratio, it means that the company has to pay more debt in response to its total assets. So this is another measure of company's level of financial risk. When it comes to interpretation of debt to asset ratio, if it is equal to 1, it means that the company owns the same amount of liabilities as its assets. It indicates that the company is highly leveraged. If it is greater than 1, it means that the company owns more liabilities than it does assets. It indicates that the company is extremely leveraged and highly risky to invest in or lend to. The ratio of less than 1, it means that the company owns more assets than liabilities and can meet its obligations by selling its assets if needed. The lower the debt ratio to asset ratio, the less risky the company is. The another ratio is interest coverage ratio. This ratio is a financial measure that is used to determine how well the company can pay the interest on its outstanding debts. The interest coverage ratio is commonly used by lenders, creditors, and investors to determine the riskiness of lending capital to a company. The interest coverage ratio is also called times interest earned ratio, and the formula is given below. So the formula to calculate interest coverage ratio is earnings before interest and taxes divided by interest expenses. It will give us the measure that our EBIT, or earning before interest and tax, is how many times that of our interest expense. So here, for example, I have mentioned these amounts: earning before interest and tax, which is 8.58 million, and the interest payment is 3 million, and the answer is 2.86. So meaning that the company can pay its interest payments 2.86 times with its operating profit. When we talk about interest coverage ratio, the lower the interest coverage ratio, the greater the company's debt and the possibility of bankruptcy. A high ratio indicates that the company, if it is very high, so it indicates that the company is overlooking opportunities to magnify their earnings through leverage. So as a rule of thumb, the interest coverage ratio above 2 would be barely acceptable for companies with consistent revenues and cash flows. In some cases, analysts would like to see interest coverage ratio above 3. An interest coverage ratio lower than 1 implies poor financial health, as it shows that the company cannot pay off its short-term interest obligations. Let's have a look at the primary uses of interest coverage ratio. Interest coverage ratio is used to determine the ability of a company to pay its interest expense on outstanding debt. It is used by lenders, creditors, investors to determine the riskiness of lending money to the company. It is used to determine company's stability, and also it is used to determine the short-term financial health of a company. Trend analysis of interest coverage ratio gives a clear picture of the stability of a company in regard to interest payments. The last one under this category is equity multiplier. Equity multiplier is very easy to understand. Through equity multiplier, it is a leverage ratio. It measures the portion of company's assets that are financed by equity. It is calculated by dividing the company's total assets by the total shareholder equity. The equity multiplier is also used to indicate the level of debt financing that a firm has used to acquire assets and maintain operations. If this ratio is high, it indicates that the significant portion of firm's assets are financed by debt, while a low multiplier shows that either the firm is unable to obtain debt from lenders or the management is avoiding the use of debt to purchase assets. Let's understand this scenario with the help of an example. You can see the total assets divided by total shareholders equity. If we divide total assets by total shareholders equity, it will give us equity multiplier. Let's assume that we are comparing two companies. One is Apple Incorporated and the other is Verizon Communication Incorporated. In March 2016, Apple's total assets stood at $305 billion, while the value of the shareholders' equity stood at $130 billion. The equity multiplier ratio in this case is 2.345 by simply dividing the total assets by total shareholders equity. So as of March 2016, Verizon's total assets were $245 billion, while the value of shareholder equity stood at $19 billion. So shareholders equity is in the denominator. So if the value is high, the result will be less, and if the value of shareholder equity is less, the result will be high. So in this case, the equity multiplier ratio for Verizon is 12.895. When it comes to interpretation, we can see that Apple's equity multiplier ratio is lower than Verizon's. Apple, an established and successful blue chip company, enjoys less leverage and can comfortably service its debts. Due to the nature of its business, Apple is more vulnerable to evolving industry standards than other telecommunications companies. On the other hand, Verizon's multiplier risk is high, meaning that it is heavily dependent on debt financing and other liabilities. The company's proportion of equity is low and therefore depends mainly on debt to finance its operations. Viewers, this was the discussion about all those ratios which comes under solvency category of ratio analysis. In the next video, I will come up with the third category of ratio analysis. I hope you would have understood the first two categories, and I will keep all the links of my videos as soon as I publish a new video on a new category. So thank you very much. Do subscribe to the channel by clicking subscribe button, and also hit the bell icon so that you will get the intimation of my next videos. Thank you very much.